we don't know the facts, we make up stories in our brain, and we also often add in a little bit more drama. Right now, the housing market, people are unsure. People are reading what's in the press. And we just want to give you some of the information that you really need to know if you're thinking of moving in this market. We look at house prices. 2020, we came out the first lockdown and we bounced back. The market was flying straight away. The median average went up by 8.5%, which is a fantastic result during 2020. 2021, buoyed by the government's incentive to increase the stamp duty holiday to a longer period, the house prices went up close to 10%. Again, another fantastic year. This year, we're actually expecting things to slow down ever so slightly in terms of price rises, but predictions are that it's going to go between 4 to 7%. We actually predict that house prices will end up 6% higher by the end of this year, and there's a lot of good reasons for that. If you forget about the 2007-2008 price crash, house prices typically raise between 3 to 5%. So with our prediction that house prices are going to go up by 6% this year, and with others predicting as high as 7%, we're still in a very, very strong market. We're expecting things to continue in this way because basically there's still a supply and demand issue. There's a great demand for properties, but there's a shortage of properties available in the market right now. You remember the loo roll crisis that came about when everyone was out panic buying. Prices of loo rolls went up, there was a high demand for it and there's a lack of supply. It's similar-ish with houses right now. There's a lack of supply, lots of people looking to purchase, and as a result, that's pushing the prices up still. It's not going to be as bonkers as it was in 2021 or 2020, but actually you'll find that still house prices are on the up. We can't build these homes quick enough, and one of the major issues is the bricks that are needed to help build those homes are going up in price still. Back in 2020, 1,000 bricks was costing around $595 for a pallet of Oast russet. They're now costing $795 for the same brick. Looking at the demand for properties, the prime buying age is around 35. Back in 2010, these were called the Gen Xers, and nowadays they're known as the Millennials. The size of that population back in 2010 was around 4.2 million, and now you're looking at around 4.435 million. So there's been an increase in the population of buyers that will be coming into the market at this stage as well. We've also got the fact that there are more households. Back in 2010, there was around 26 million, just over 26 million households, and now we're looking at over 28 million households in the space of 11 years. We don't think this market's going to drop. We think it may well slow down slightly. The increase in interest rates will have an impact on buyers' borrowing power, but what we're not going to find is a drop off in interest in properties. Predictions are the house prices are going to go up between 3 to 7%. We predict they're probably going to end up about 6% higher by the end of 2022. Back in 2007, 2008, I remember working in the market and there were a lot of properties being repossessed. Banks and building societies had lent money to people that couldn't afford it. In essence, you were able to get 125% mortgage when you didn't have any deposit at all. This reckless lending caused a problem, and I remember the amount of repossessions we were called out to assist with. Those are properties that were taken away from their homeowner because essentially the homeowner couldn't afford to pay the debt that they had on that property. Right now, there are very few repossessions. The government have brought in some stringent ways to ensure that buyers are stress tested to ensure they can afford the properties. They've gone through details like your receipts, how often you travel to a restaurant. All these items have been considered when they've been able to lend a purchaser for their mortgage. Right now, demand is increasing. There's 235,000 more millennials in the UK. There's also an increase of 1.8 million households throughout the UK as well. All these things are impacting the demand and the amount of buyers that are out there looking for properties right now. The biggest problem we've got going on at the moment is the shortage of housing. It doesn't seem to be any way out either. There's just not enough homes being built and there's not enough properties coming to the market. If it's the right time for you to buy, it's the right time for you to buy. If you feel like it's the right time to sell, similarly it's the right time for you to sell. You're not going to lose out in this market. You'll find over time that whatever you buy at, it's going to be worth way more in 5, 10, 15, 20 years time from now. Right now, there's a lot of people that are frustrated because back in 2019, what you could have bought for your budget is no longer available. You're now having to spend an extra 10% typically, sometimes 15, sometimes more than that, on the property that you could have bought if you were in a proceedable position back in 2019. That's happened to me. I mean, I wish I was around when I could have bought a house for £44,000. I didn't get that opportunity either. But if you keep looking at what could have been and not purchasing, then you're only going to be in a worse position as time goes on. What goes up must come down is rubbish. It's not an economic view at all. In essence, If you are waiting for something to come down, I think you're going to be very disappointed. We don't see that happening with the house prices. We see them gradually, steadily rising, not at the speed they've been going at, but they are still going to continue. If you're seeing price reductions on the internet, on the portals, with agent stock coming down in value, that could be that actually they were flying a kite at the beginning. They were very ambitious with their asking price, and now, because their motivations changed, because they haven't had the interest they thought they were likely to get, they're getting themselves to a realistic figure. Doesn't mean that house prices are dropping, it just means that the opportunities are increasing for you. Something that may have felt like it was a stretch too far is now coming to a level where possibly it's the right thing for you to go for. Some people think the market's unstable and they think that it couldn't continue in the way that it was going. That's right in a way. I mean, the prices were flying, and I think what you're finding now is it's just tempering down slightly. We had a black swan event, we had an event none of us could have planned for. There was government assistance helping people to purchase properties. And if I was you, if you missed out on that section, you might have done yourself a favour, because now it feels a little bit less frantic, a little bit less erratic. And actually you're getting a bit more choice as more stocks come into the market. We've seen a steady increase in instructions in these last couple of months, kind of post lockdown. And as everyone starts to get back to normality, it feels like the market's returning to normality too. You might be interested to know, if you haven't bought yet, that actually there's people that bought in the last 24 months who are actually frustrated. They felt that they had to move quickly. They bought the one that they could afford. They bought what they saw on the market, but actually they've gone on to regret buying that property. Now, actually, if that is you, I wouldn't worry about it. Chances are the house price has probably increased further. So if you're not happy where you are at the moment, consider getting in touch. We can come out and see you and let you know what yours is actually now worth and what we can do for you. Don't get shackled to the house that you bought 24 months ago. If you bought it because you needed to move, if post-lockdowns it was the most important thing for you to do to move on with your life, we completely get it. But if you're actually regretting the one you went to, don't worry about that. That happens to all of us. You only spend normally 15, 20, 40 minutes viewing a property, which is one of the biggest investments of your life. Our recommendation is, if it doesn't feel like it's the right house for you, think about getting moved on now. This market's still increasing. Your house price could have gone up since you bought it anyway. What is a recession? A recession does not relate to the housing market. It's something that people get confused all the time. A recession is when GDP drops 2 consecutive quarters. Next question you're asking, what is GDP? It's gross domestic product. That's basically the goods and services sold throughout the UK, and it's worked out every single quarter. First quarter of this year, it rose by 0.8%. The data's now in for quarter 2, but it hasn't been shared yet in terms of what position it's in. If you hear people talking about the recession causing a housing crash, they're not related. They're 2 separate things. People often mistakenly link recession and house price crashes together. You could have a recession and it doesn't affect house prices. Back in 2008, there was a house price crash which actually led to a recession. And the reason it led to a recession is because banks and building societies were recklessly lending to borrowers who had massive multipliers, getting into a significant amount of debt. There's 125% mortgages. I mean, you didn't even need to have a deposit. You could buy a house and then buy a car as well. You had money left over. Those times are gone. Now banks and building societies are really quite careful about who they lend to. They've been doing stress testing from borrowers since 2014 to ensure that not only could you pay for the current mortgage, but if increasing costs came about as well, as we're expecting with energy suppliers, then actually you could still afford to pay the mortgage plus the energy supplies and still live, still feed yourself, still bring in the food to the table. So we can't see this going the same way. There's a weak economy right now, that's true. GDP has reduced, people aren't spending so much on the goods and services, but it's not actually related to house prices. They're 2 separate things. The Bank of England base rate is still extremely low. We do think it's going to increase further. We think by the end of this year it possibly will be as high as 2.5%. But back in 2007, to put that in context, it was the Bank of England base rate was at 5.75%. So it's a long way off what we've known before. Parents of yours or people that have bought in the market before will remember the days when interest rates at the Bank of England were actually 16% plus. We're way away from those dates. What we're actually at now with the interest rate where it's set is kind of pre-COVID days, which again was fantastic rates. Rates would be really pleased with it, 1.25% Bank of England base rate. What you find is the lenders, obviously they don't just lend to you at those interest rates. There'll be an extra maybe 1.5%, 2% on top. So you're expecting rates to be around anything around 3.5%, 4% at the moment. Prices are going to be up by 6% at the end of this year. We got it right in 2020, we were close in 2021. You can save this post and you can see if we're right at the end of 2022. Reason it's going to be up by 6%, a lot of factors. Supply and demand, you've heard that enough. We can keep telling you that there's not enough houses. Everyone knows there's not enough houses out there. There's 77% more first-time buyer mortgage products out there at the moment. Banks are desperate to lend their money to you. They're happy to keep their rates low. Bank of England base rates are rising and they will keep theirs above, obviously, the Bank of England base rates, but they want to lend to you. Their own costs, staffing costs, IT costs, they've gone up by about 20% in the recent years. So they need to ensure that they've got people like you borrowing from them. That allows them to recoup their income and allows them to pay those bills. So unless there's another million homes being built that we're not aware of, we're going to find that it's going to continue in the same vein. Now, it's not as high as the 10% that we experienced last year or the 9% we experienced the year before, but at 6%, it's still far greater than the normal 3 to 4% that most prices rise by each year.